Hello and welcome to CoronaNomics What Just Happened, where we look at the biggest events in yet another historic week with you, our live audience. You can ask us a question on our YouTube comments or head over to Twitter at #CoronaNomics. I'm Lizzie Burden, economics reporter at The Telegraph.
And I'm Ben Chu, economics editor of The Independent. So the last 7 days have seen Donald Trump announce he's self-medicating with hydroxychloroquine, not bleach. Germany's restarted its football season, and in England, McDonald's has opened some of its drive-thrus.
Hooray!
Get a load of those queues in Sutton, which is quite near me, but I assure you I was not part of them. Anyway, joining us to talk about all that and more is Torsten Bell, head of the Resolution Foundation, one of Britain's leading think tanks. Torsten was previously Director of Policy for the UK's Labour Party, and before that, he worked for the Treasury. So, Torsten, thank you so much for joining us and being our first guest on CoronaNomics Live.
Good to be here, guys.
Our first question to you.
Good luck with the first show.
Thank you very much.
Thank you.
So, looking back, Torsten, what is your big moment of this week?
Well, I think the big moment for this week is the moment when at 7 a.m. on Tuesday, a large dump of data about our labour market, about the jobs people have or did have, came through. And that really confirmed that what people have been experiencing over the last 2 months at individual levels, losing their jobs, having their hours cut, finding it harder to apply for new jobs, that started to come through in the official data. And we saw 450,000 fewer employees in the course of April coming through HMRC's tax system. And we've also seen the number of vacancies, i.e. how many new jobs are out there in the economy, fall down by 50% in just 1 month. Those are huge changes.
Was it as bad as you expected, Torsten, or were you expecting maybe worse?
I think these are broadly in line with what we're expecting. We are engaged in a very, very unusual kind of economic crisis where we're shutting down whole swathes of our economy, and we're particularly shutting down swathes of our economy that employ a lot of people, and they in particular employ a lot of lower earning people. So that is what we are seeing coming through in these figures. But, you know, there's one thing seeing your expectations, seeing the theory. Now what we're seeing is these are real people, real lives. And this is a really deep, deep crisis.
Absolutely. Now, Lizzie, what was your moment of the week?
I'd have to say it was when bond yield dropped into negative territory. So investors are now paying the government, paying the state for the privilege of lending to it, which is a big sign that maybe the Bank of England will also sink into negative rates territory, which would be the first time in its 326-year history. We also had hints from the Bank of England Governor Andrew Bailey and the Chief Economist of the Bank of England, Andy Haldane, and Silvana Tenreo, who's on the Monetary Policy Committee, that this might happen. She said that negative rates had a positive effect in Europe. But I think a lot of people are really worried about negative rates. You know, in Sweden, the Swedish Riksbank was the first to pioneer negative rates, but it reversed the experiment back in February. And a lot of people are wondering, if you make it unprofitable for banks to lend, you know, will they lend as much? And don't we need to have lots and lots of spending and investing to get the economy fired back up if we're meant to have a recession of historic proportions as we keep on hearing? So, Torsten, can I ask you, should we be glad that the Bank of England might be willing to do whatever it takes, to use that phrase of Mario Draghi's that we heard from Rishi Sunak, or should we be worried about what negative rates might mean for the average saver or borrower?
I think the people that are very keen on negative rates and those that think they're kind of the devil both need to calm down. They are, they've made some difference in some economies, but we are really, the underlying issue, which is that in this crisis, the thing that is very different is that the Bank of England cannot provide the bulk of the support to the economy that we are used to providing in recessions. Cutting interest rates, big QE, those things, cannot happen on the scale that we're used to. And that is why the fiscal policy, the government is having to do the heavy lifting. Now, would negative rates make a big difference to that? No. The big structural challenges that are there will exist whether or not you can cut to just below zero or not, because nobody's talking about cutting a long way below zero for lots of structural reasons with the way our financial system works and the fact that we can hold our money in cash. So for lots of reasons, the debate is overdone. The Bank of England has been very reluctant, partly to do with technical issues about our building societies, but also because they are worried it wouldn't make that much difference. That is broadly still my view. If you want to do it, it's probably not going to do loads of damage, but equally, this is not the answer to a very deep recession.
Great. And Ben, what's your biggest story of the week then?
Well, I think an important moment was when Therese Coffey, who's the Work and Pension Secretary, was asked about some of the government's failings in dealing with this crisis. And what she said was quite interesting. She said, if the science advice at the time was wrong, I'm not surprised people think we made the wrong decision. Now, the grammar of that sentence is slightly tortured, but I think the implication is basically don't blame us. Blame the scientists or the scientists on which they base their advice on. In other words, I think, and a lot of people have said this, it's probably setting things up for preparing the ground for a bit of the blame to be shifted off politicians to the advice they were given. So I think that is quite an important moment about what we're in for in the coming weeks and months ahead.
Torsten, do you think it's fair to say that the government's kind of hiding behind the experts?
I'm just mainly glad they're blaming the scientists, not the economists yet. That is where we usually end up in these situations at some point. Yeah, no, I think, again, this is a very unusual recession from another reason, which is what's caused it. So normally recessions are caused by either economic policy developments or economic policy failures, be it going into the ERM at the wrong exchange rate in the late 80s and early 90s, or under-regulated banks and under-capitalized banks in the 2000s. And in those worlds, it's economic policy that can answer the underlying problem that's driving the recession. Here, this is a completely other world where we do need to be reliant on scientific advice, because that is the core thing that is causing the economic problems. And until we solve that side of things, then on the economics, all we can do is ameliorate the damage. So one, science has to be central. That's the nature of this crisis. Two, whether people think they got absolutely the right advice at every single stage is not surprising, because basically this is really hard on the science, is what we're all learning. But three, we're all in it together, to coin a phrase. We should be listening to that advice, but then in the end, politicians decide. And as someone that spent time advising ministers, I think it's really important. The burden of who actually owns the decision in a democracy is really important. And that's not just in your constitutional classes, it's in the real world.
Great. Now, if you're at home and you're watching, don't forget, if you've got a question, leave it in the YouTube comments or head over to Twitter at #CoronaNomics. Now, thinking about how we unwind the furlough scheme has been a hot topic this week. Here's a question from Matt Griffith. Have we got that?
Hi.
Here we go.
Ben, Lizzie and Torsten. I'm Matt Griffith. I'm a Director of Policy at Business West, which is the Chamber of Commerce for West Country. I just want to ask a question about probably the biggest issue in relation to the phasing out of government support, which is what the impact of the Chancellor's measures on furloughing would be, and the tension there is, or the balance there is, between, on the one hand, clearly different business sectors are going to be unevenly experiencing the easing of lockdown, with potential much longer periods of not being able to operate fully for places, things like hospitality, tourism, and retail, versus the treatment of all businesses on an equal footing in relation to how furloughing will be eased, and particularly the shift of burden of some of the costs which will kick in August through to October. And just be good to get from Torsten a sense of what the Treasury's thinking is here, what they sense the reaction might be, and in particular whether they are almost expecting that there will be a spike in unemployment and layoffs from those business sectors that will not be fully operational and therefore will be unable to meet that kind of greater burden of costs.
Fantastic. So over to you, Torsten.
There's a big question. In fact, lots of different questions in there. So the job retention scheme is obviously by far the centrepiece of the government's response to this crisis. 8 million jobs having their wages paid, 80% of their wages paid by the state. We've never seen anything like that before. The most important thing to say about that scheme is that it's really important that we don't, some people have been in favour of ripping that plaster off, saying people are getting addicted to it and we should just get on with getting rid of the scheme. That is a very bad idea when the country is already on course for the highest unemployment in 25 years. But it will need to be phased out over time. And that's partly because the way to think about this, the reason this is hard for policymakers is in the short term, we've got really clear objectives. Keep people keep their living standards up, pay their wages, and also keep them attached to their firm so that we can make sure that those good quality relationships that help build a stronger recovery are in place. People can go back to do jobs that they're used to doing when we're able to lift the a lockdown. But as we move further away from the hard lockdown and into the phased reopening of the economy, some social distancing going on, changing the way we operate, but not hard closures, then our incentives and the government policy does need to shift towards helping both give firms the incentive to open up as far as they can. So they can't just leave their workers off the books and get those paid by the state. We want them to bring workers back if they can. And obviously we want workers, if they're not going to be able to go back to the job that they've already got eventually, it's not in their interest that we just leave them out of work for 6 months paying their wages, because history tells us that's very bad for their long-term careers. So those are the trade-offs the government faces. Now, they've given their answer so far, the government have, which is the scheme will exist in its current form until August. Then they will start employers making some contributions. Now, what some contributions means towards those costs is now still to be determined, and the government's got 9 days, I think, until to set out what they think that is. And that is a really difficult decision. If they go too high, ask government firms to pay, say, 50% of furloughed workers' wages, then lots of firms may be pushed into deciding, right, well, in that case, I'm just going to lay people off and not try. Or if they go too slowly, the danger is firms don't open up at the pace they should. So, and the reason it's difficult is because different sectors are going to be in a different place in August. And so if they set a high number, that might work for accountancy firms, but it's not going to work for hospitality firms who will just lay people off in thousands. So the answer is, one, you probably should have sectoral differentiation, which the government so far has been reluctant to engage in. My view is they probably should be dealing with that, even though it is very difficult and messy. If you don't want to do that, you end up introducing sectoral differentiation by the back door. So instead of making the scheme different for different sectors, you just give them money to pay it. So I just make a grant to the hospitality sector to pay that money back to me, and I get to the same result via another route. So that looks like where they're heading, but you're definitely going to need something like that. And we should all be prepared, even if we get this policy completely right, we are going to see another phased increase in unemployment claims as the job retention scheme starts to be wound down.
Looking back slightly, Torsten, I mean, the job retention scheme was very similar to something that the Resolution Foundation proposed before they come out. But do you feel a degree of pride that the government basically adopted a scheme with broad outlines of which you were recommending?
I definitely do think the government has done the right thing. And I think it's really important to understand, when you face an economic crisis, it's really important that your policy response isn't just the general, I'll do what I normally do in recessions. It's got to be targeted at the focus of this recession. And so this recession, what is very different is how sectorally variated it is. So some sectors closed down entirely, some still operating. And in that world, if you just focus your macro policy response on giving everybody some money, trying general fiscal stimulus, which is what you would do in a normal recession, it won't work, because the people you need to get support to and create economic demand for are working in the sectors where we can't get the economic activity to take place, like retail and like hospitality. So you need a targeted scheme that gets money to those in need. So
we had the jobless figures, which you mentioned earlier, Torsten, this week, but we also had a different Resolution Foundation report showing how young people have been disproportionately impacted by the job losses and furloughing. We've had a question from Owen Morris, which is on this theme, and he asked, what is the route to solving widening generational inequality as a result of the pandemic? He also asks, will the pandemic finally see mainstream economics focusing on wider measures of well-being? Now, that's a question that we dealt with in a previous episode of CoronaNomics. Do check it out on YouTube. But I wonder if you could tackle the first one. What is the route to solving wider generational inequality? How do we do it?
In the short term, what we need to deal with is the generational challenges that are coming hard and fast right now. And that is that a third of younger workers have already either lost their jobs or been furloughed. And that's roughly twice the rate of the workforce as a whole. And that's happening partly because they work in sectors that are most affected, and partly lots of young people in hospitality, lots of young people in retail. But it's also because young people tend to be on the first one in, first one out principle, most affected by job losses in recessions in general, not just this one. But these are huge numbers. And it's not just about those who are leaving their jobs now. It's also that you see young people being less likely to benefit from the furlough scheme or the self-employment scheme because of the way the scheme is set up. They can't qualify. They weren't in the system in time, and also less likely to have savings to fall back on in these tough times. So what should the government do about it? Well, the most important thing, as well as helping people right now with their incomes, is to make sure that when the recovery comes, we have active labour market policies targeted at getting the young back into work, so that we don't see the scarring that we've seen in the recessions of the 80s and 90s to young people's prospects. And we know from history that if we do nothing, the employment rates and the earnings of those who are entering the labour market today, young people, will be scarred for 3, 4, 5 years by significant amounts. And particularly people without degrees, 3 years after the recession, we could see their employment rates being anything like 30, 40% unemployment rates higher than they would otherwise have been. So these are big, big potatoes. We should be guaranteeing jobs for young people. We should be focusing apprenticeships on young people. This is like a serious task for policy in the months ahead.
Excellent. Now, please do ask a question on the YouTube comments or on Twitter using the hashtag CoronaNomics. Now, we've got another question here on a related issue by John Lish. Now, just as a bit of context, we've seen this sort of dig for Britain, pick fruit for Britain campaign by the government. We've also had Prince Charles suggesting that furloughed workers should come out and pick fruit and vegetables. John's question is, so we have lots of unemployment, yet the government is attempting to interfere with market economics by running a volunteer scheme for farmers. What's wrong with increasing wages so there's more supply of labour? Isn't this counterproductive from HMG? Torsten, he's right. He's got a point, isn't he? Because why don't we just put the wages up? Then we don't have to have these volunteer schemes, and then people will go out and pick fruit, in the natural course of the market economy working.
That is excellent optimism amongst in the market economy at a time when we're basically shutting down large chunks of the market, all left, right, and centre. Now, there's a number of challenges here, right? First of all, let's just assume we did that, okay? So we whack up wages. You earn £50 an hour for picking strawberries. How many strawberries do you think are actually going to get picked? Because I will go and pick the strawberries at that price, but no one is going to buy the strawberries at the cost they're then going to cost in the shops. So I think that there's more than one aspect to the market. There's a labour market, but there's also the market for the things that are actually being picked. And I hear that price will affect how many goodies from the fruit pickers you actually buy. Right.
So your view is sort of keep them on the minimum wage and hope they.
No, I'm being flippant. In general, my view is whenever anybody moans about skills gaps or like not being able to recruit people, then my first answer is always put up the wages and stop banging on about skills gaps. All I would say is these are not normal times. So if what you want is to get that fruit picked because we put in a lot of the economic investment in making that happen, then you may need to increase wages a bit, but there's a limit to how much that can do. A lot of these businesses don't have that high margins in the first place, and at some point, let's be honest, loads of this stuff is going to go unpicked over the course of the next few months, and that is what the question a lot wants the market economy. Well, that is what the market economy is going to deliver. There's obviously a bigger challenge here, which is in the long run, we're having to adjust sectors of our economy at least to the interregnum, this intermediate phase before we get out properly with a vaccine. We're going to be in a long phase of social distancing, lower migration, people having to move between sectors because we can't have as many people working in some sectors we had in the past. So those changes are going to be difficult. They're particularly difficult because wages don't tend to adjust very quickly. They definitely don't adjust downwards when they need to fall, and they adjust slowly upwards because firms are very reluctant to increase wages in the middle of a recession. So that adjustment is really difficult, and that's the kind of underpinning serious answer to my rather flippant view about how much you want to pay for your strawberries.
Yeah, I just point of fact to after the Black Death, I think there was such a dearth of labour that wages did go up structurally just because they had to for the work to get done. But I think Lizzie's got another.
I'm hoping not that many people are going to die.
Absolutely.
Yeah.
Well, thank you, John, for that question. And don't forget, if you've got a question, go to our YouTube comments, leave us one there, or go over to our Twitter and you can use hashtag CoronaNomics. Now, another story that I want to talk about, Torsten, is the Sunday Times Rich List found that £54 billion was knocked off the wealth of the richest in our society in the 2 months of the pandemic. But today, the Resolution Foundation's got another report saying that if you factor in capital gains, the very richest have been getting richer faster than we ever thought over the past 2 decades. Now, what I want to ask is whether or not it should, how realistic do you think it is that the government will hike wealth taxes to pay for all these coronavirus measures?
So what our report, and as you rudely say, another report,
you're very high productivity.
That's better. That's better. High productivity. Someone's got to keep it up in the difficult times, right? So what the report says is that our traditional measures of income in Britain focus on what most of us think of as income, like the amount we earn, how much we bring home from our jobs, or if we're lucky, the dividends we get from holding some shares. And that's what we see in most of our income stats. That's what we base our inequality measures on. But there are some other big sources of income that actually look a lot like those kinds of income. And one of them that stands out is capital gains. So this chart is showing you on the bottom in the green line, the percentage of overall income that the top 1% have on the existing measures. So i.e. it's been broadly flat over the last 15 years, around 14%. But if we include capital gains, and capital gains is the money you make if you sell something for more than you bought it for, and is both big, we're talking £55 billion, it has grown fast, which is why the gap between the two lines has gone up in recent years. It's doubled in the last 4 years, but also it's very concentrated. So it's most of it, 92%, goes to the top 1%. So once we take that into account, what we see is, one, that the top 1% has a bigger share of income, 17%, not 14%, but also that the increase in their share of income has been twice as big as we thought it was over the last 20 years. Now, then the question is, what do we do about that? Well, right now, what's happening, obviously, is the capital gains are going through the floor along with everything else because our share prices are going down, no houses are getting sold. You don't want to be a buy-to-let landlord trying to sell your house right now. But the longer-term trend that is going on here will reassert itself as we move out of the recession. And we need to have that in our heads when we're thinking about both the state of Britain in the 21st century and what tax policy should look like. And definitely when we look at capital gains, and I think I hear what you say, which is, is a Conservative Party, does it get out of bed in the morning wanting to put up taxes on wealth? Clearly not. But the Chancellor has already taken a big measure, which is to cut a big relief for capital gains, entrepreneurs' relief in recent years. And that will bring down significantly probably the amount of capital gains we see.
Yeah.
Cool.
Yeah.
So it'll bring down the capital gains we actually see, but it will also bring down, it will also mean that people have to pay more tax when they sell their firms and other things. So I think we're already seeing significant steps by the government. Will they go further? Well, that's to be seen after the crisis, but closing some of these reliefs, making the system fairer, will be a lot easier than putting up taxes on ordinary workers.
Great. Well, we've got a question on the same subject from Jane. Jane, is Jane there? Hi, Jane. Oh, we can't hear you.
One moment, forgive me. The joys of live broadcast. How's that? Hello.
Good. Hi.
Hi, everyone. I'm Jane
Hello.
Kinninmont, a political analyst based in London. But I want to turn to the US, where there's been some controversy this week as the $2 trillion coronavirus economy support package turns out to contain an estimated $160 billion worth of tax breaks for the wealthiest Americans. And Time magazine reported this week that the family of Jared Kushner, the president's son-in-law, were among the real estate tycoons who lobbied for this. So I'd be interested in your views, Torsten, about is this sort of thing just elite capture? Or are there good economic reasons why very wealthy investors might be asking for tax breaks at this time?
So I think, I don't know the details of the specific US program, but what we do know is that there has been some question marks about whether rich individuals who own companies should be using the furlough scheme. For example, in the UK, is that taking money that they shouldn't be accessing? I think we even saw today a complaint about a peer claiming for his own salary cost being furloughed. A Lib Dem peer, right, there we go. Thanks for clarifying, Ben. So those issues are around. All I would say is we should be a little bit careful, because the reason we are having the retention scheme in the UK is to keep people getting their wages paid during a massive recession. And so we don't want people not taking up that scheme or feeling like they shouldn't. So in the US, what they haven't done is to pay firms to the same degree for keeping their workers on. So that is why they're having much bigger political problem about giving money to people where the benefit is much less clear directly to workers, is much more to do with just supporting the economy more generally. But again, all I would say in this crisis is, one, clearly, if we are going to have actual big bailouts for sectors, airplanes is the one, airlines is the one that stands out, then we're clearly going to want to ask for conditionality, and we may want to ask for equity in exchange for it. But when we're looking at our broad support for the economy as a whole, no sector and no workers caused this pandemic. And I don't think we should be looking for this is not the banking crisis over again. It's not our chance to get the bankers having not done enough last time. We need to prioritise sorting the economy, protecting families' incomes, protecting firms, businesses. If we need to go further to bail out some sectors for particular reasons, then I think we should look at the wider conditionality question. But the key thing we have done is to protect workers first, unlike in the US, and that makes this issue much easier to deal with here.
Jane, does that answer your
Thank
question?
It does. Thank you.
Great. Thanks, Jane.
Brilliant. Now, yeah, I mean, I think that's a really interesting point you make, Torsten, about not getting muddled up with the concept of demanding conditionality when the priority is actually just to stop jobs being lost, to prevent businesses going under. You can sort out capitalism. We could have done it over the past decade. Now is not the time to do it. If it gets in the way, this is my view, if it gets in the way of doing those really urgent things that you need to prevent the productive capacity of our economy being permanently damaged. Now, so we've talked a little bit about the difficulty of opening up sectors, but what about borders? We've got a question from Ian from Ontario on this really important question. I think there should be a clip from Ian. Yeah.
About border closures. How do small countries bordering big neighbours that they rely on but are struggling with coronavirus outbreaks decide when and how to reopen borders while balancing economic interests and healthcare outcomes? I'm especially thinking of Canada, but there must be examples across Europe and South America as well. Hi.
So Torsten,
that is a really hard. I think it's a really hard question. It's a really hard question, and the reason it's hard is because, in some ways, as we get in general, we're all thinking about this optimistically as a linear journey, where we put a hard lockdown in place, that gets a grip of the virus, and then we can start easing off the lockdown and hopefully don't mess it up. R stays below 1, and we continue on our journey until we manage to get a vaccine to solve all of this. Obviously, there is one big difference here, which is even if you do that and it all works, then your approach to migration probably doesn't fit that same pattern. Whereas it's less of an issue being really tight on migration when you're in the heat of your epidemic. As you ease out of it and you have lower numbers of cases in your country, then whether you can control people coming in with the cases becomes much more important. And that is what we are now wrestling with in the UK. And I wouldn't say, we've changed our policy on that a few times in the last 2 weeks. We've now stopped the French coming in without being quarantined. But that is understandable. I think it's a bigger problem for small countries that have a large amount of their workforce working across a border. So that's less of an issue, for example, for us. But if you live in Belgium, Luxembourg, lots of these people are crossing international borders for their day-to-day job. And in the end, they're probably going to end up being exempted, I'd have thought, from the quarantine restrictions that countries are going to be putting in place. And you'll end up with some exceptions, which will be less of a challenge for us. The challenge for us is more going to be that sectors of our economy that are more reliant on very short-term migration flows. Again, we were talking just now about agriculture. That we're going to see much bigger challenges there, and we may end up with more bespoke solutions for those parts of our economy.
Thanks, Ian, for that.
So yeah, if you've got a question like Ian, ask it on YouTube comments or using the hashtag CoronaNomics. So I just wanted to ask you, following up on that, Lizzie, I mean, you're a specialist trade reporter. This whole question of people not being able to cross borders must be very, very difficult for people who work in that sector. Are you finding that from the businesses you talk to?
Yeah, I mean, it's an issue for immigration. A lot of service industries, which make up a massive part of British trade, are affected by this. So, of course, we need to get back to normal as soon as possible. But, of course, trade is, we need to prioritise health. So it's a very difficult situation. It's affecting the whole world, though. Don't forget that. So global trade is expected to contract by, I think it's a third this year. So
yes,
this is not a British, exactly. It's not a British unique issue.
Yeah,
and there's also a question mark about how permanent those. But yeah, definitely the whole Brexit issue, and there's the what's the long-term effect on globalization. So there's no one can trade right now for obvious reasons, and we couldn't buy the stuff in lots of cases, even if we could get it shipped into the country. But the longer term issue, which is lots of people talking about greater resilience, more onshoring, wanting more capacity, there are good arguments for elements of that because of what we've learned in terms of our need to have some options for supply within the UK. But a lot of that also does mean if it happens across the whole globe and every country does it for itself, that is a phase of deglobalization. That is an element of supply shock that further damages the chance of a strong recovery from this crisis. So these are really difficult decisions to make.
Yeah, and
it's
we've actually
interesting.
just done an episode with. Yeah, go on, Lizzie. Go ahead.
I was going to say we had an episode with Harjun Chang that is on our Twitter and our YouTube now, but he was saying that he doesn't expect deglobalization, even though we've had all these threats from Donald Trump that there should be a decoupling of the US and Chinese economies. He just doesn't think it's possible because the supply chains are just too integrated and it's too efficient to get things made more cheaply in Asia. So he just doesn't think that supply chains could be brought home, even if it means more local resilience.
Yeah, he had a really interesting line, didn't he? He said, if Donald Trump had come around, if he'd been president in 1995, he might have had a chance of doing it. 2020, he's sceptical for the reasons that you mentioned, Lizzie.
Exactly.
And remember, if you've got a question, ask us on YouTube comments or fire us over in Twitter with the hashtag @CoronaNomics.
Now, let's talk public debt. So Rishi Sunak was on the Treasury Select Committee this week, and he hinted that the government isn't intending to pay down the debt straight away, and also that he wasn't as confident as the Office for Budget Responsibility about how quickly we'll come out of a recession. The Telegraph, not this week, but just a bit before, also leaked some Treasury documents about potential spending cuts and tax rises that we might have to pay for all this coronavirus spending. Torsten, you used to work in the Treasury. I wonder what the officials will be up to there at the moment when it comes to preparing for the fiscal aftermath of all this.
Well, people will be writing the kind of papers that the Telegraph covered a few weeks ago. My actual view is that that it is wrong to see the internal Treasury view as being a kind of back to austerity, definitely heavy deficit reduction as a priority. I'd say in the short term, if we look at what's actually happening, we're heading towards £300 billion worth of borrowing this year. The Chancellor has actually been pretty gung-ho in terms of the borrowing that they're doing. We're probably about half that borrowing comes from actual policy decisions to do things like the retention scheme, and half comes from just the damage to the economy, pushing up borrowing in the normal way as taxes fall and spending rises. So I'd say I would caution against a simplistic view of what is going on. But what is really important is that we take the different jobs that fiscal policy in the Treasury has and make sure they're done in the right order. So, for example, right now the job is to support firms and support workers through this really difficult phase where we're asking them to stay at home, help us to protect lives, and we have to protect their livelihoods if we're going to do that. Then we do need to secure the recovery before we do anything else. That means that we need to make sure we've got strong growth returning. Those unemployment rates are coming down quickly. Last time in the financial crisis, unemployment stayed above 7% for a full 5 years after it went above it. So unemployment does not just come back down again. However, whatever your economic forecast looks like, nowhere in history does unemployment fall as fast as it has risen this time. So we need to make sure we deal with that. So as we wind down these targeted support schemes, we probably need to dial up generalized fiscal stimulus and fiscal support as we move into the autumn and early 2021. And then when the recovery is going, that is when it's right to have a conversation about the consolidation and the deficit reduction phase. My view is that when that comes, that conversation will be focused on the tax side this time rather than on the spending side. And that's because just like life, countries are path dependent, i.e. we've just taken 7% of GDP out of our spending over the last decade. We're not going to repeat that exercise again. Anyone that's been around our prisons, been around our local government in recent years, looks at the public demand on social care, looks at public attitudes to wanting more tax and spend, we've doubled the number of people wanting more tax and more spending compared to 2010. So the world has completely changed. I don't think we're going to be set for a repeat. What we are going to be set for is tough choices, probably some tax rises to deal with the current budget deficit, and then not being able to do the increase in spending that we might otherwise have done. And that's where the politics is going to come in. How far do those tax rises go? And what does that buy you in way of reversing austerity?
Well,
Ben, talking about unemployment, do you think Andy Haldane said this week that he expects a 1980s style level of unemployment? Are you that pessimistic? Or are you an optimist on unemployment?
Well, it's all a not normal recession, isn't it? Because of the furloughing scheme. If the furloughing scheme wasn't in there, we would have probably seen, the worst levels of unemployment, certainly since the 1980s, probably before. are people who are furloughed unemployed? It's an interesting philosophical question. I think it's definitely right to sustain their incomes, and probably not right to sort of go into that question too much. I think Torsten was exactly right in what he was saying before. It's focusing on the right things for policymakers, and I think they've done a decent job of it so far, but it will be intensely difficult to get to the next phase of it for all the reasons he was saying. I just wanted to follow up, Torsten. You were talking about wealth taxes. We've had a question from Paul Kearney on that subject, and he asks, if the virus leads to slumps in asset markets, won't this make it harder to raise money from wealth taxes? Now, presuming these taxes come in a year or so's time, it's possible that asset prices will have largely recovered. But is that a problem, do you think, that if you are trying to raise money from wealth, from assets, the amount you get in will depend on fluctuations in the value of them?
Yeah, so there's clearly, will it have an effect on what wealth taxes bring in right now? Absolutely. We've got public sector finance figures out tomorrow morning. For April, they'll probably show stamp duty receipts falling as transactions on housing, but also the value of stocks and shares and other things start to fall. So yes, we will see wealth-related taxes starting to bring in less money. We don't obviously have a wealth tax that's directly tied to the value of assets on individuals in a way that some countries have had in the past. I think, yes, some people talk about big new wealth taxes that cover all of people's wealth, but also just think about, how our tax system deals with existing things that don't feel as radical as that. So, for example, your tax-free lump sum for your pension is currently very generous. You could still allow most people to take very large tax-free lump sums, but save billions of pounds by just capping the huge amount that you can take at a lower amount than £250,000. So there's changes we can make in our pension system, in our housing taxation system, which if you look at our council tax system today, everybody, I think, basically agrees it's a complete joke. So there are things you can do that are not directly tied to current asset prices. But yes, in the short term, he's completely right that there is a heavy relationship.
Gosh, can you imagine if one of the legacies of this pandemic is we finally sort out council tax, move away from those 1991 values for the base of it?
That'll be a silver lining to a disaster.
Well, that's all we've got time for. Thanks so much, Torsten, for joining us on this inaugural episode of CoronaNomics Live. And thanks everyone for joining in, watching and sending in questions. Please do keep them coming in for future weeks. And we very much welcome suggestions on things that we might be asking about, things we might be doing.
And you can also watch our latest full episode on YouTube. It's an interview with Harjun Chang, development economist at Cambridge University, on what the West can learn from the East and some of the myths that might surround all that. Don't forget to also follow us on Twitter at CoronaNomics TV for all our latest updates.
Thanks for watching CoronaNomics What Just Happened. Join us for more next week. Goodbye.